Hello friends. In today's video we will explore in depth the well-known triangle chart pattern, which often delivers the most powerful breakouts in the stock market. There are two primary kinds of triangle patterns, one being the ascending triangle pattern and the other being the descending triangle pattern. Let's jump straight into the video. But hey, if you find this interesting, smash the like button, and if you're new here, subscribe and turn on the notification bell so you never miss our latest uploads. I'll see you right after the intro and disclaimer. First of all, we will discuss the ascending triangle pattern. The ascending triangle is considered a bullish pattern, and it indicates the continuation of an upward trend in the market. During a bullish trend, you will notice the creation of higher lows on the chart. This is the sign of a strong bull market because the price keeps rising consistently, and yet buyers continue showing interest by purchasing at higher levels. This means the bulls currently dominate the market, while the sellers keep trying to push prices lower but fail to succeed. Even with the rise in price, buyers continue entering the market, showing that demand still exists. The price is trading close to the resistance level, yet buyers are firmly holding their positions. At this stage, there is no effective resistance in the market and no real selling pressure. If selling pressure existed, the price would not remain near resistance for long. Instead, it would reverse and drop sharply. Many new traders place their sell orders near resistance levels, with their stop losses positioned just above the resistance line. If the market moves higher from this point, all those sellers' stop losses will get triggered, causing a very strong upside rally in the market. If you are trading around YouTube, then the advice is to short sell there, but you cannot short sell at every resistance level. This point must always be kept in mind, or else you may get caught in fake breakouts and end up facing losses. Where should you enter the trade? In this chart pattern, to take an entry, you must wait until the resistance level is broken. Once the upper resistance level breaks with strong volume, you can take a long trade entry, but this remains a risky move. A better approach is to wait for the price to break the resistance line, move upward, and then pull back. At that point, use the broken resistance line below as your new support. As soon as the price breaks its recent high and the candle closes above the high of the previous candle, you can enter the trade. This way, your risk will be reduced, and you will avoid being trapped in fake breakouts. Where should you place the first stop loss? If you set a stop loss around the most recent swing low, the chances of it being hit are high because many new traders, just like you, will place their stop loss in the same area. Large institutional traders are aware of this, so once the price reaches that level, the probability of stop loss hunting increases. Therefore, you should position your stop loss slightly below this area to avoid stop loss hunting and to remain in the trade. How should you set a profit target? I personally prefer using the trailing stop loss method because no trader can predict how long a market trend will continue, and you would not want to miss out on capturing that trend. Therefore, whenever you trade in a trending market, it is wise to apply a trailing stop loss. To remain in the trade for a longer period with a trailing stop loss, you can use the moving average indicator. Whenever the price drops below the moving average and the candle closes beneath it, you should exit your trade. If you are an intraday trader, you can use the 20-period moving average, which works well on lower time frames and makes it easier to apply a trailing stop loss. For swing traders, you can use the 50 and 200 period moving averages to set your stop loss, which helps you capture maximum profit. Now, let us discuss the descending triangle pattern. The ascending triangle pattern signals the continuation of a bullish trend, while the descending triangle pattern signals the continuation of a bearish trend. In this case, the price moves downward within a range while forming a series of lower lows, which indicates that sellers are prepared to sell at lower levels and want to maintain their dominant position in the market. At the same time, buyers are willing to enter at these lower levels, but due to their smaller numbers, a pattern of lower lows develops. How do you make a trade entry? Since the descending triangle is a bearish continuation pattern, whenever the price breaks the support line below, you can enter an aggressive trade. However, if you want to enter more cautiously with reduced risk, you should wait for a trade setup near the support level of the price. Sometimes, the breakdown of a descending triangle occurs so quickly that you may not get enough time to enter manually. In such cases, you can enter by placing a stop order. Where should you place the stop loss? In the descending triangle pattern, you can set your stop loss slightly above the most recent swing high, which minimizes the chances of your stop loss being triggered. All the sellers who have opened short positions will have their stop losses placed near the recent swing high, and the market can often move upward to trigger those stops. By positioning your stop loss slightly above that zone, you can protect yourself from stop loss hunting. How should you set the profit target? To set the profit target, I would once again recommend using the trailing stop loss method because the breakdown in this chart pattern often continues for a long duration, and to take full advantage of it, the most effective approach is applying a trailing stop loss. Professional traders use this technique to capture maximum profit, so whenever you trade in a trending market, the smartest choice is always to use a trailing stop loss. To remain in the trade for a longer period with a trailing stop loss, you can apply the moving average indicator. Whenever the price breaks below the moving average and the candle closes downward, you can exit your trade, which will help you secure maximum profit. That's it, traders. Thank you for watching. I hope you gained real value from this video. If you did, make sure to hit that like button. It truly supports the channel and shows us you're enjoying the content. And if you're new here, don't forget to subscribe for more trading strategies. Thanks for watching, stay disciplined, stay consistent, and I'll catch you in the next episode.